Welcome to the Way of Wealth. I'm Corey.
And I'm Lily.
Today, we're introducing a very special figure, Jim Rickards.
What makes him different from the experts we've covered before?
Rickards is a former advisor to the CIA, Pentagon, and White House, and also a former advisor to the U.S. Treasury. In 1998, when the hedge fund long-term capital management LTCM collapsed and nearly dragged down the entire financial system, he represented the Federal Reserve in negotiating the $3.6 billion bailout. Even more notably, he participated in the Pentagon's first-ever financial warfare simulation.
Financial warfare simulation? That sounds like a movie plot.
But it actually happened. He doesn't look at gold from an investment angle, but from a national security threat perspective. This viewpoint is very rare on Wall Street.
National security threat? That's definitely a different angle.
Rickards published Currency Wars in 2011. He makes a core argument. Currency wars aren't just economic or monetary issues, they're national security issues. He believes the real threats facing America include three dimensions: China's secret gold purchases, hidden agendas of sovereign wealth funds, and the risk of the dollar itself collapsing.
Why would China buying gold be a national security threat?
Because of scale. Global official gold reserves are about 35,000 tons. When a country goes out and buys 3,000 to 4,000 tons, that's 10% of global official gold. This isn't ordinary asset allocation, it's preparing to change the rules of the game.
This reminds me of MacLeod's final settlement theory. Gold is the only settlement tool with no counterparty risk.
Exactly. Rickards divides history into three currency wars. The first was from 1921 to 1936, starting with Weimar, Germany.
That's the example of pushing wheelbarrows full of cash to buy bread?
Precisely. Weimar Germany's hyperinflation led to the collapse of the international gold standard, and countries began competitively devaluing currencies to gain export advantages. Britain, France, the United States all participated, and the result was the Great Depression.
So currency wars have no winners.
Right. The second currency war was 1967 to 1987. In 1971, Nixon severed the dollar's convertibility to gold. The Bretton Woods system ended, followed by the great inflation of the 70s and 80s. Rickards says the U.S. basically defaulted through inflation, causing the purchasing power of dollars returned to creditor nations to plummet.
That's the same as us saying America has always used inflation to solve debt problems throughout history.
Completely consistent. But Rickards says the third currency war from 2010 to now has even greater risks.
How so?
His exact words are, "The risk today is not just of devaluation of one currency against another, or a rise in the price of gold. The risk today is the collapse of the monetary system itself, a loss of confidence in paper money, and a massive flight to hard assets. Las quedas."
The entire system collapsing. That's a serious consequence.
That's why he looks at this from a national security angle. Rickards estimates China's official gold reserves are close to 4,000 tons, far higher than officially published numbers.
How did he calculate that?
He broke down China's annual gold acquisition sources. The first source is domestic Chinese mining over 400 tons per year. The second source is imports through Hong Kong, about 700 tons. The third source, and the most interesting, he believes China might be secretly importing gold through Central Asian military convoys from Russia or Kazakhstan, estimated at around 400 tons per year.
Military convoys secretly transporting gold. Why do it this way?
Because the gold market is actually quite small. If China openly bought 10 tons of gold on the market, prices would spike. But if through secret government-to-government transactions, buying 1,000 tons at once, the market doesn't know and prices aren't affected. This is what Rickards describes in his book in the simulation. Russia agreed to buy all of China's gold, about 1,000 tons, all at once, paying with Russian foreign exchange reserves.
That's the largest single gold transaction in history.
Exactly, and with no market impact. These three sources combined mean China acquires about 1,500 tons of gold annually. If this continues for 5 years, that's 7,500 tons accumulated. Assuming about half goes into official reserves, that's close to 4,000 tons.
If that number is real, it's truly stunning.
More important is the motive. China holds about $1 trillion in U.S. treasuries. Rickards did the math. Every 10% of dollar inflation equals $300 billion of wealth transferring from China to the United States.
So they're building a hedge position.
Right. Rickards says China actually wants a stable dollar. But the question is, will America give them a stable dollar? History tells us no. From the continental currency during the Revolutionary War, to the greenbacks in the Civil War, to the inflation during the Nixon and Carter eras, America has always used inflation to handle debt problems.
So China can't trust America to protect their wealth.
Right. China's strategy is clear. If the dollar is stable, their treasuries have value, and it doesn't matter if gold doesn't rise. But if the dollar depreciates, the losses from treasury depreciation can be offset by gold appreciation. It's a perfect hedge.
That's a very smart wealth insurance strategy.
And Rickards points out, China hasn't finished buying yet. They'll continue accumulating until the hedge position is large enough. Think about it. If China buys 1,500 tons of gold annually, in 10 years, that's 15,000 tons. That number would approach America's official reserves of over 8,000 tons.
At that point, gold pricing power won't be in Western hands anymore.
Right. And that's the national security threat Rickards talks about. Not that China will attack America, but that they can use gold to weaken the dollar's position. But what's truly impressive is the Pentagon financial warfare simulation he participated in.
What scenario did they simulate?
They modeled Russia launching a gold-backed energy currency. In this simulation, Russia announced that future energy transactions must be paid in the new currency dollars would no longer be accepted. Rickards describes a very absurd scene in the book when the Russian delegation announced this strategy. The Pentagon referee team actually said the strategy was illegal and demanded it be deleted from the simulation record.
Illegal? There's such a thing as illegal in war simulations.
Rickards and his team were stunned. They said, "This is war. Where does illegal come from?" But the referees insisted the strategy was too aggressive and didn't follow the rules. This actually reflects a problem American decision-makers simply aren't prepared to face this kind of financial attack.
So the value of the simulation is right there exposing blind spots in thinking.
Exactly. The further development was establishing a non-dollar trading network. Members included China, Russia, Iran, Turkey, North Korea, Venezuela. Iran sells oil to China. China sells infrastructure to Russia. Russia sells natural gas to Turkey. North Korea sells weapons to Iran. The entire network uses cryptocurrency for accounting, then periodically uses gold to settle trade deficits.
The dollar is completely outside this network.
Right. Rickards says this is completely feasible and is already developing in this direction. Look at Iran selling oil to China now, settled in yuan. China-Russia trade is also increasingly using their own currencies. This network is being built piece by piece.
That's why gold is called the ultimate settlement tool.
Exactly. When trust collapses, only gold has no counterparty risk. This completely echoes what McLeod says. Rickards also has advice for ordinary people. He suggests allocating about 10% gold to hedge other assets. His exact words, "If this strategy is good enough for China, it's good enough for the rest of us."
That percentage.
This is Rickards' personal view. The Way of Wealth doesn't endorse any specific allocation percentage, because everyone's situation is different and needs to be decided based on their own financial situation and risk tolerance. The key is understanding the logic behind it. Hedging strategy, wealth insurance.
Right. Understanding the principle is more important than copying the percentage.
Rickards also proposes complex systems theory. He says traditional economics assumes the economy is in equilibrium, where small changes can be managed. But complex systems are characterized by nonlinearity, with many interconnected feedback loops where small events can trigger system-wide collapse.
Black swan events.
Exactly. He specifically warns that inflation can stay low for a long time, but one day might suddenly turn to hyperinflation, happening almost overnight. He uses an analogy. Snow can accumulate flake by flake, looking very stable. But one snowflake falls, and the whole pile collapses. You never know which snowflake is the last straw.
So you can't wait to see signals before preparing.
Right. He also points out that all the institutions that were too big to fail in 2008 are now bigger and more dangerous today. The biggest banks rely on even more derivative bets, and risks keep accumulating. Rickards personally experienced LTCM's collapse. He knows how terrifying derivative leverage is.
LTCM nearly dragged down the entire system then.
Exactly. And LTCM was just a hedge fund, tiny compared to the big banks now. LTCM used a strategy called convergence trading, betting that the price spread between two related assets would return to normal levels. But in 1998, Russia defaulted. Markets panicked. All correlations broke down, and LTCM's models completely failed.
The models assume markets are rational, but markets aren't rational during panic.
Right. Rickards says, if the Fed hadn't intervened with a bailout, then LTCM's collapse would have triggered a chain reaction that could have destroyed all of Wall Street. He learned from that experience that complex system behavior under stress is unpredictable.
So that's why he warns the current system is more dangerous.
Completely correct. Rickards warns the next crisis will be worse than 2008 because the system is more complex, more fragile, with higher leverage. And this time, governments might not have room to bail out because debt is already too high.
This is very similar to what we say about can't use current mindset for the future.
Completely aligned. Rickards looks at gold from a national security perspective. Not short-term speculation, but as a hedge against systemic risk. He warns that the purpose of the gold standard isn't to make gold appreciate, but to limit governments' ability to print money infinitely. When this constraint is removed, governments abuse the printing privilege, and the worst case is hyperinflation, hurting everyone.
So gold is essentially a check and balance on the fiat system.
Exactly. Under a gold standard, if government wants to increase money supply, it must first acquire more gold. It's like an automatic brake system, forcing government to maintain fiscal discipline. But after Nixon cut gold convertibility in 1971, this brake failed, and government can print money infinitely.
The result is the current $39 trillion in national debt.
Right. Rickards has a famous quote, "Gold is not an investment. It's not a commodity. Gold is money." This quote is important because many people treat gold as an investment target, expecting it to appreciate. But Rickards says gold's real value is preserving purchasing power, not making money. Gold has been money for 5,000 years. Only in the last 50 years have people forgotten this.
This definition is very clear and aligns with our wealth insurance concept.
Rickards reminds us that currency war endgames have 4 possibilities. First is SDRs, the IMF special drawing rights, becoming the new reserve currency. Second is returning to a gold standard. Third is multiple regional currencies coexisting. Asia uses yuan, Europe uses euros, Americas use dollars. Fourth is chaos, no stable monetary system, everyone scrambling for resources.
Which does he think is most likely?
Chaos. Because governments won't easily give up the printing privilege, but simultaneously can't maintain confidence in their currencies. During this transition, there'll be a long period of chaos. Rickards says this chaotic period could last years, even a decade.
During the chaos period, what assets are safest?
Rickards says real assets, gold, silver, land, art. These things don't depend on any government's promises and have no counterparty risk. Paper money and stocks and bonds are all forms of promises, but history tells us these promises are often broken during crises.
So real assets are the final safe haven.
Right. But Rickards also reminds us not all real assets are the same. Gold and silver's advantages are divisibility, portability, and global recognition. Land is also a real asset, but you can't put it in your pocket when fleeing. Art preserves value but is hard to liquidate during crisis.
So what can we do?
Deploy ahead. See the essence of wealth clearly. Understand gold's role as the ultimate settlement tool. Rickards says when the entire system faces a crisis of confidence, only real assets can protect your wealth. Paper money is a government promise, but history tells us this promise can be broken at any time. Only what you can touch truly belongs to you.
This completely aligns with the Way of Wealth's core philosophy.
Exactly. What Rickards saw in the Pentagon financial warfare simulation, we should also see the East-West financial war has already begun. Most people just haven't noticed yet. When they notice, it might already be too late. We plan, but heaven decides. But at least we can be prepared. Bye.
Bye.